So now let's first talk about why is personal finance even important. See, a study was conducted in United States, right, the richest country in the world, and what they found out is very shocking. So that's why I thought I'll show it to you guys first. Out of 100 people, only one ends up becoming rich by the time they're 65. 4 out of 100 become financially independent, which is what all of us should be able to achieve at least. All of us should at least become financially independent, if not rich. And in United States, only 5 out of 100 are able to do it. The remaining 95 people are dependent on their kids, right? The richest country in the world, people are not able to do it. In a country like India, where inequality, the financial inequality, the wealth inequality is so big, right? The numbers are much, much worse. Can you imagine what I'm trying to say here, guys? Over 40-year period, right? Most people start, let's say, earning from 25 to 65. Over a 40-year period, the success rate of actually becoming financially independent, which is the whole purpose of going for a job, right? The success rate of becoming financially independent is just 5%, right? Any other profession you take, right? Let's say for me, example, as a content creator, I've been doing it for 2 years and I'm fairly good at it, right? Or let's say you're an engineer, you study mechanical engineering for 4 years, and then maybe within 4 to 5 years of your job, you're pretty good at it and you start climbing up the ladder. Or you're a doctor, you do it for 10 years and you're a pretty good doctor. But finances is one such thing, guys. No matter how many years you spend, you're still not able to crack the code. And the problem for that is the reason for that is because it's not taught to us in our schools, right? Now they're actually starting to inculcate it in the school's curriculum. But what about the people who already graduated like us, right? Who are going to teach us all of these things, right? We are all caught clueless regarding this. So the point I'm trying to make here is that handling your finances is not as easy as just getting your money and investing it in some place. You need to have a proper foundation and proper framework in place before you can actually go about doing it. Otherwise, you make a lot of mistakes which can have repercussions over your entire life, right? So for that, first we need to forget some of the things that we have learned. So what are the common Indian money mindsets that I need you to change, that I need you to forget right now? Okay, let's get to it. The first one is real estate myths, right? So real estate is the darling asset class of India, right? Any middle-aged person or old person that you ask in your family, they're going to say, beta, invest in a house as soon as you start earning a good amount of money. That is the mindset that has been put onto us. Now, before you go into the 5 points on the left, I want you to draw your attention to the chart on the right side, the snail space chart. So this was a study conducted by the Ken, which is a reputed publication. And look at the growth in the real estate over the past 10 years, I believe. Yes, over the past 10 years. Not 10 years, my bad. Over about 14 years. See what has happened. Mumbai, the average growth rate has been about 4.57%. I am from Bangalore, it's around 5.7%. So it's not that much better than fixed deposits, right? These returns. Now the problem with fixed deposit, if you had invested in fixed deposit and if it's getting 6-7%, which is still okay because that's not a big amount, right? That is probably maybe you put like 4 to 5 lakhs, and it's probably that money is meant for 1 to 2 years from now, which is okay. But when you put a crore in a house, in an asset like house, and over 20 years, if it's giving you 4 to 5% returns, that is pure wealth destruction, guys. Right? Now you might say, Sharan, my dad invested 10 years back, and now the value of the house has become 30x. True. That is because we have seen a never before seen real estate boom happening in our country, right? And that is probably like a once in a lifetime thing, right? It's not going to happen every time. Like so, coming to the points on the left side, right? The lure of magnificent returns from early 2000, right? The second point. Let us do a simple exercise, right? I'm in Bangalore. The average value of a decent house in a good locality in Bangalore is around 1 crore. Now, if you assume that the real estate price will again see 30x returns over the next 10 years, a normal house is going to cost 30 crores in 10 years. Who do you think is going to be able to afford a 30 crore house in Bangalore 10 years from now? Right? Because 10 years is not a long time to consider. So, when the demand reduces to buy 30 crore house, which it definitely will, no one is going to buy it, right? And when no one is buying it, the prices drop. So, because of that entire logical understanding, we can safely say that real estate prices are not going to grow 30x in the next 10 years, right? That is a simple fact of life. But most people are still hoping that will happen. And why are we hoping that will happen? Because we're hearing these stories from our parents and our grandparents of stories like that happening in the past. But it's not going to happen every year, every decade, right? These are once in a lifetime opportunities. Next, house prices only go up, right? So the reason why we feel this is because we never get to see the price of the house change every single day, like the stock market. Stock market, they tell us every single day that it has fallen by so many points, it has increased by so many points. So that sort of is constant information being fed to us about the happenings of the stock market. But you don't get to know about the price of the house like that. So, but in reality, house prices also go down, right? Don't think that house prices only go up. Right? For example, in the late 90s, if you ask your parents, they'll tell you in cities like Bangalore, Mumbai, and Delhi, the house prices fell by around 30 to 40%. Right? So don't assume that house prices will always go up. Another argument which people make is, Sharon, land is limited. So obviously, if something is limited, then the price will obviously only have to keep going up, right? No. I'll tell you what is happening. In Mumbai, what they're doing is, Mumbai is known for having some of the tallest buildings in India. So what's happening is the older buildings, which were 20 floor, 30 floor, that is normal there, those are being taken down and they're making 50 floor, 100 floor building, because on the same piece of land now they can put more people, right? So that is the thing, right? It's not that don't look at it from horizontal expansion of land, but look at vertical expansion of land, and that is unlimited. So don't assume that because land is limited, price is always going to go up. And the third point is absolute versus compound returns. When somebody is telling you how much money they made in real estate, ask them over how many years, right? Because sometimes they might say, it has doubled in 10 years, but doubling in 10 years is like 6-7%, right? So be very, very, always look at returns from a CAGR perspective, compound annual growth rate, and not from an absolute perspective. Fourth one is stocks are riskier than real estate. I already told you. It's because we think we are bombarded with information about the stock market every day, whether we want to hear about it or not. Influencers are always talking about markets fell by so much or so much. These are all headlines worthy news. So that is why we are always thinking stocks are risky. But nobody's bombarding us information about real estate price fell by so much, in Bandra prices increased by so much. You don't get to hear those kind of information every day. But the truth is, stocks are not riskier than real estate. Even real estate has a certain amount of fluctuation called volatility, which is actually almost on par with that of the stock market. And last one, home is an investment, right? So the problem here is that, guys, see, if you're buying a home and giving it for rent, that is an investment. But if you're buying a house and living in that, it's not an investment. I'll tell you why. Because a house, right, when you're living in a house, it is not able to generate returns for you to feed you, right? But if you're giving it for rent, that rent is coming and is giving it and feeding your mouth. But when you're living in the house, it is not feeding you, right? It is actually a lifestyle expenditure, right? You're actually paying the bank to live the house, or tell other people that, what, boss, this is my house. I am not renting anymore, right? People get that sense of achievement to tell other people that, I'm living in this house, right? So you're actually paying money to the bank in the form of interest to have that privilege. And having that privilege doesn't make the house as an investment. It is actually a lifestyle choice, right? And don't tell me that, you can sell the house, because if you sell the house, you're only going to buy another house and also a bigger house, right? So net house is not an investment. It is only a place where you're locking in a lot of capital, which is growing at what? 4 to 7% interest rate, right? And another important point I want to point out here is that, just one second. Yeah, another important point I wanted to point out is that buying a house in India is the most difficult if you consider all the countries in the world, right? I'll tell you why. In US, right, let us consider US because we like comparing ourselves to US. An average house is about 5 times your annual income. See, annual income in US is around $50,000. It's very easy to get a house worth $200,000 or $250,000 in US. In India, the annual average income of an Indian will probably be 4 to 5 lakhs. I'm talking about metro cities here, including everyone, not just the top 1% people. And the average house, right, it's around 60-70 lakhs in a metro city. So as you can see, it's 20 to 30 times more than your annual income in a country like India. So when you consider all of that, what you can observe is that buying a house is 20 times harder than buying a house in the United States, right? And the study which was conducted by a leading publication in the real estate sector, what they did was they looked at the GDP, they looked at the price per square feet divided by GDP per capita. So GDP per capita is nothing but the GDP of a country divided by the population, right? So that's sort of giving you how that India is the 5th largest economy, but we have 1 billion people, right? So if you divide that big GDP number divided by the billion people, that number becomes very, very small, and that is called GDP per capita. It is an indication of how rich we are on an individual level, not just on a country level, right? It's easy to say India has surpassed UK, but UK is just an island. It's a small island with less number of people, so their GDP per capita is much higher. Whereas India, we are marginally more than UK in terms of GDP, but our population is 10 times more. So GDP per capita of India is very, very low. So if you do that price per square feet divided by GDP per capita, India's real estate is very, very expensive, right? So now what are these other myths that I want to talk about? So next is the amount of risk that you can tolerate is based on your age, right? So this is one very big myth that people have, that if I am old, if I am in my if I am retired, then I cannot take any risk. I have to put all my money in fixed deposit. Or if I am 20, then I can take a lot of risk because I'm very young, so I can put 100% in equity. So there's this famous rule called the 100 minus age rule. Meaning if I'm 26 now, meaning what it says that 100 minus 26 is 76, so 76% should go into equity. That is what the rule says, and people are blindly following that. I'll tell you the flaw behind that. The flaw is that let's say I'm saving for my higher education next year. Now, if I follow this rule, I have to put 76% in equity. Now, putting 76% of my money in a risky asset class like equity, when the money is required next year, is shooting myself in the foot, right? When something is less than 2 to 3 years away, 100% of the money should be in debt, right? So basically, what I'm trying to say is the amount of risk you can tolerate is not a determinant of your age. It is a factor of how soon that financial goal is coming for you. Right? So this is what I was talking about, how to approach investments. Right? You approach investment from a financial goals point of view and not based on your age or how much risk you think you can take. Right? It's based on how far away that financial goal is. Right? So that is number one thing. On the other hand, let's say a person who has retired. Let's say he has retired with 10 crore rupees. Okay, and let's say he has done very good in his life, and he had lot of increments, lot of promotions. So he has saved much more money than he'll ever need in his life. Now, if you tell him to put all his money in FD, right, that is like, that money is eventually going to go to his son and daughter, right? Now, if that money was in FD, that's a disservice to his son and daughter, because that money could have grown much faster if it was invested in the right places like equity, because that money, he anyway has more money than he needs. So that balance money is anyway going to his kids who have another 40, 50 years to live, 60, 70 years to live. So the point I'm trying to make is, don't look at investments from an age point of view, look at investments from a financial goals point of view. Next, zero risk is the best investment option. Here, the point I wanted to make is, see, most people think that that they only want to see the money grow in a straight line up. They don't want like to see up and down, right? They think that up and down means it's risky and you're gambling. Now, the problem with that is the only investment which goes up straight like this is fixed deposit. Now, if you put 100% of your money in fixed deposit, what will happen? You will not be able to beat inflation. Post-tax returns of fixed deposit is around, 4 to 5%, and inflation is around 6-7% right now. So you will lose your money against inflation. So the point is, taking zero risk is a kind of taking risk, right? It's like taking absolute risk. Meaning, the moment you say that I'm taking zero risk, it means that with 100% certainty that you have taken a risk, because you're not able to beat inflation at all. But if I've taken some risk and put in equity, then I know there is a risk of fluctuation, right? But the risk of not beating inflation has significantly reduced because I've taken some risk with my investments in equity, right? So that is the point. Next, investing means stock picking. See, with any field of life, when we think, for example, let's say cricket, the first thing that pops in your mind is maybe Sachin Tendulkar or Virat Kohli. That's because we humans always think about the best in any field, right? So when it comes to investing, obviously stock picking is something which has been romanticized and which has been popularized in books and publications and media, right? It is, that is what all the media likes to talk about. Nobody likes to talk about, this guy has invested his money patiently and with a lot of discipline in mutual funds, and today he has become financially independent. Nobody likes to talk about those stories. Everybody wants to hear, this guy has invested in a multi-bagger stock which has become 20x in 2 years, right? So that is what everybody likes to hear. But the problem is, let me tell you, that is first of all very difficult to do, right? It is not that everybody can pick multi-bagger stocks and become the next Rakesh Junjunwala. It appeals to us because we like to get rich quick, right? Nothing wrong with that, but it is appealing to the wrong side of us, and we want to get rich quick, and in the hope of getting rich quick, we make a lot of mistakes and lose money. Let me tell you that you never have to learn how to pick a stock to live the life that you want. Let me repeat that. You never have to learn how to pick a stock to live the life that you want, right? So basically what I'm trying to say is, investing is not just about stock picking. There is a whole lot of other things when it comes to investing, mainly goal planning, asset allocation, tax planning, insurance planning. Nobody wants to learn all of this. Everybody wants to know, Sharon, which stock to pick? Is this the right time to invest in that stock, right? But that is immaterial. 90% of your investing performance depends on your asset allocation. Okay. Number 4 is buying gold jewelry is an investment. I think most of you already know, a gold jewelry, when you walk out of the showroom, you lose 12% of the value, because there's something like making charges, right? The jeweler, he charges you making charges. So next day, tomorrow, if you go and try to sell the same jewel, let's say you buy it for 1 lakh, and if you try to sell it to him next day, he'll give you 88,000 rupees, right? So next time your mom tells you, we are buying all of this jewelry for the marriage, and if you ask her, isn't this a waste of money? She'll tell you, it's an investment. You tell her this. Next is, you should buy investment products from well-known companies like SBI, LIC, HDFC. I've seen many people, what they do is they open their investment app and they see, they scroll through mutual funds because they don't know how to pick mutual funds. And then they'll see names that they recognize, SBI, LIC, HDFC, big names in our country, and they directly invest in these companies without knowing. Now, I'm not saying these companies are bad. I'm saying, but that's not the right method to pick mutual funds, right? Maybe there is another, mutual fund company which you have never heard of, but has performed really, really well over the past 4 to 5 years. You will never know about those kind of companies if you only look at names of big companies, right? And also avoid products like ULIPs and chit funds. These products are usually sold by reputed companies only, like ULIPs and all are sold by some of the biggest financial institutions of our country. But I would definitely avoid these kind of investment products. Never mix investing with insurance. And chit funds, I worked in a chit fund company when I was in KPMG, and the investment returns are like close to 4 to 5%. Right? These are mostly legacy investment products, like your mom and dad would have invested in chit funds, and they tell you, you also invest in chit funds. But I would say avoid them altogether. Life insurance products are better if they give us money after the policy expires. So this is a favorite of mine. See, insurance as a product in India is very difficult to sell, right? Insurance penetration in India is only 4%, right? Which is one of the lowest in the world, right? Insurance actually is one of the first things that you need to take care of before you ever invest your first rupee, right? But the problem with insurance is, it is supposed to work